Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, we're talking about cash. Cash is king. It's relevant to everything that we do. We have money coming into our household each month. We have money going out of our household each month. It's relevant to our businesses. Cash is pervasive in the financial world. And I think most people appreciate the fact that it's important to have a little bit of cash set aside for a rainy day in the form of an emergency fund. But I think a lot of people out there don't quite know how big that emergency fund needs to be or where to park it. Should it live in my checking account or my savings account? What are the options and what makes sense to me? So this week on the podcast, we're talking about cash. How big should your emergency fund be and where should it live to be safe and liquid and accessible, yet squeeze the most interest and yield that you possibly can out of it? So we cover these concepts in this week's episode, as well as some potential reform in the money fund industry, and I hope you enjoy it. Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. So this week on the podcast, we're going to be talking about what to do with cash. We all like cash. We like to receive cash. You can have too much cash. You can have too little cash. The idea of how to manage your cash, and if you feel like you have enough, where to park it, is really a pretty big deal in most of our day-to-day finances. And you have your checking accounts, obviously, where you pay bills out of and have your paychecks deposited into and that kind of stuff. But you might want a little bit of emergency cash, either a liquidity fund or emergency fund or whatever you want to call it, just saved away for a rainy day. And it's actually a really important part of having a sound financial plan, financial household. It's just having a little bit of extra cash laying around for a rainy day if something really bad happens or if a bunch of really bad things happen. And so today on the podcast, what I wanted to do was just review why we want to do this in the first place, why it's important to have some cash, and how we might think about that. And in more detail than that, one of the options for parking our cash is what's called a money market mutual fund. I wanted to spend a few minutes talking about that because there's been some proposed reforms in the way that money market funds are structured that could have an impact. So let's take it from the top here and just talk about why it's important to have a little bit of cash. I probably don't have to cover this in too much detail, but quite obviously, if you don't have a little bit of cash set aside for a rainy day, and one or more bad things happen in your life, maybe you have an unexpected medical expense, or there are layoffs at work, or I don't know, so the meteor crashes through your roof, and you have to get the house fixed or something like that. You have an immediate need for cash. And the whole point of prudent saving and investing and financial planning, we want to use the capital markets to our advantage and grow our savings over time pursuant to our wishes and our financial objectives. One really important way that we do that is by buying low and selling high. And so we just want to have flexibility and not have to sell securities at an inconvenient time is the whole idea. And so that padding, that emergency fund, just provides a margin of safety to where if a bunch of bad things happen all at once and you need a little bit of cash, you don't have to tap into your investments. You don't have to tap into your retirement accounts and take an early distribution, pay tax, sell investments potentially when the markets might be depressed. We don't want to have to do that. We want to weather out bad times in the economy and use the capital system to our advantage. because capital markets tend to foster growth. That's how this system tends to work, our economy and the global economy. And just by being broadly diversified in the markets and being invested for a long period of time, we'll be able to take advantage of that. So how much cash should you have? I think I've talked about this on the podcast in the past, but ideally, we want to think of it as a function of our monthly living expenses. So if you have an idea of what you're spending to exist each month, so you add up your mortgage, rent payments, how much you're paying for groceries, utilities, fun stuff, just give yourself an idea. And if that totals $10,000 a month, hypothetically, you probably need somewhere between 6 and maybe as many as 24 months worth of living expenses in cash. And the way that I like to think about this is on that spectrum, where you sit depends on your capacity and comfort level with risk, so your risk tolerance. It depends on how many incomes you have in your household. If you're retired, you might need a little bit more cash, depending on how comfortable you are with where you're drawing your retirement income from. Depends on a number of different factors. How much of that monthly budget are fixed expenses you cannot change, like your mortgage, versus discretionary expenses that you might be able to haircut a little bit if you had to, like bar tabs or entertainment, things like that. So where you fall on the spectrum is a very personal decision. But notice that the short end of that spectrum, 6 months worth of living expenses, not coincidentally, aligns with the elimination period for a lot of long-term disability policies, which means that if you're not able to work for a long period of time, you have at least enough cash built up to where you can exist until the long-term disability benefits kick in, is a pretty common way to go about it. A lot of people who work at bigger companies have pretty robust short-term disability policies as well. But the whole idea is we're trying to build some kind of margin of safety into your household finances in order to ensure that you never have to sell securities at an inconvenient time. Because we're trying to buy low and hang on for a long time and sell high when you need to live off those assets a long time in the future. So that's kind of the backdrop here. So the question is, well, if you've got $13,000 a month coming in to your household and $10,000 a month going out based on your budget, well, what do you do with the extra $3,000? And it depends on how much cash you have. Are you funding your retirement accounts? Have you done that yet? Are you saving for kids' college? Have you talked about that? Do you have those 6 to 12 to 24 months worth of expenses in an emergency fund already parked in the bank? Where you fall depends on what to do with that excess. And if you've already funded all the accounts, you already have your emergency fund topped off, and you have more cash than you need, that's when you think about investing that extra $3,000 in a taxable investment account in your name, maybe jointly with the spouse, maybe in the name of your trust, because all the other tax advantage stuff you've probably already taken advantage of. Now, a lot of people get to that point too, and they say, well, $3,000 extra a month, now it's time to think about the vacation home or taking more elaborate or elegant vacations or something like that. And that's fine too, if that's in alignment with what you're trying to do financially long term. But we don't want to have too much cash is the point, because interest rates are really, really low right now. It's very important to have a little bit stashed away for a rainy day, but we don't want to have too much, because long term you're going to be much better off investing them, even if the market's relatively expensive right now. So with that in mind, let's say that you're already there. You have extra cash coming in that you're allocating toward maybe investments or saving toward the vacation home or something else. You have your emergency fund intact. Now, here's the question of what do we do with it? Does it live in the checking account? Probably not, because a savings account is going to provide the exact same FDIC protection, and you're usually limited to the number of transactions out of that account, in and out of that account every month.
at most banks at least, but you might earn just a little bit more interest on those deposits than you would in a checking account. But still, because interest rates are exceptionally low right now, still, although maybe they'll increase if we see a couple months more of inflation, um, we want to be good stewards of that cash. And the rules for the emergency fund are that it has to be liquid at all times. We don't want to take risk with it, market risk with that at all. It has to be accessible and available to us. And we really want to squeeze the most interest out of it that we possibly can. So another option is what's called a certificate of deposit. You might be familiar with a CD. You can go to your bank and say, hey, I've got this cash saved up in savings, but I'd like to earn a little bit more interest. What options do you have? They might say, well, I've got this 3-month CD. And in exchange for locking up that cash for 3 months, so in the savings account, you can take it out whenever you want, and you're going to get a little bit of interest on those deposits. With the CD, you're locking the funds up for a specified period of time. It might be for a week or 2 weeks or up to 2 years, any period of time. Generally, the longer that you lock it up for, the more interest that you get on the deposits. But we don't want to lock it up for too long of a period in a CD, because this needs to be accessible cash. This is your emergency fund. And if you need the cash because something bad happens before that CD matures and the funds become available to you again, then you have to pay a pretty hefty penalty usually for accessing the cash. So what the bank is saying is that we can pay you a little bit more interest by taking your deposits and putting them into the CD, but we're going to reduce your accessibility in exchange for that. So one way to slice this up is if you have, let's say you have a $100,000 emergency fund in savings right now. Well, you could potentially keep 1/3 of it in the savings account. With another third, you could buy a 1-month CD. And then with the final third, you could buy a 2-month CD. And so that way you have the next month's worth of living expenses available. 1 month from now, that first CD matures, that cash becomes available. And so if the roof caves in tomorrow and you need to use these funds to live off of, every single month you have successive CDs maturing to make that cash available, yet maximize the interest that you're getting. So that's one way to do it. It's called a CD ladder. It's not terribly ornate. It's not terribly high yielding. You might squeeze a little bit more than you'd otherwise get in a savings account. For the most part, I have 2 favorite vehicles these days when it comes to an emergency fund. One of them is a high yield savings account. Ally Bank, Capital One offer pretty competitive rates pretty much all the time. And the idea there is they're banking institutions that don't have hardly any brick and mortar locations, although Capital One has these, I think they're called Capital One cafes or something like that. Basically bank branches. They do have a few brick and mortar locations you can walk into in big cities, but they're predominantly online in nature, which saves them some operating costs, which they generally pass on to depositors through higher interest rates. So the high yield savings accounts at Ally and Capital One usually have some restrictions. You're not allowed more than maybe 5 or 10 transactions a month in the accounts. But that's really fine, because if you ever had to use the funds at all, if something really bad happened, then you can take 100% of the balance and move that into your checking account in one transaction. So that's not really a limitation. And when we're comparing rates you might get across all these different options, you'll usually get more out of that high yield online savings account these days than you will through a CD at any other ordinary banking institution. So that's one of my preferred go-tos when it comes to, okay, we have the cash, now what on earth do we do with it? Now, granted, if we're talking about a $100,000 emergency fund, that's a lot of extra cash, but we're not talking about a whole lot of extra interest. we're talking about, less than 0.5%, I would say. So yeah, that'll squeeze a few extra bucks per year out of deposits like that, but it's really not going to move mountains. But the benefit is that you have it in one of these banking institutions. It's FDIC protected up to the first $250,000, and there are a bunch of options. Another outfit I might mention here is called Max My Interest, and the idea with this is that you open an account at this. I don't know if it's technically a banking institution or not, but you deposit funds into an account at Max My Interest, and they turn around and open bank accounts on your behalf at a bunch of different banks that they track interest rates on. And what they do is they shovel your balances around on your behalf based on what institution pays the most interest at that time. So they're optimizing the interest that you're getting by playing that game of, all right, here's the top 15 banks, who's paying the most interest today? And rather than you having to send the balances between them every other day, Max My Interest will do that for you. I've heard pretty good things about them. I don't have any direct experience, but it's an interesting concept. And if there's value, meaning that there's if you make more interest than the fees that you incur for doing that from Max My Interest, then perhaps it's worth it. But really, so high yield online banks, option number one. Option number two are what are called money market mutual funds. Now, at banks have money market accounts too. And that's not exactly what I'm talking about. Those are a little bit different. You don't get quite as much interest out of money market bank accounts. They're a reasonable option for emergency funds, but you just don't squeeze quite as much interest out of it these days. What I'm talking about are money market mutual funds, where you put your cash into some kind of investment or brokerage account, and then you purchase a mutual fund that is only investing in the money markets. And it's a reasonable place to store cash, but there are a lot of nuances here that I wanted to cover. And for those of you who have assets in money market funds, there's some potential reform on the table that the SEC is discussing and gathering comments on that you probably ought to be aware of. There's a pretty good article in the Wall Street Journal here this last week about how asset managers who handle these or manage these money market funds are a little bit concerned about potential reform coming down the pipe. So here's the background. Let me start by describing what money market mutual funds are. Just like any other mutual fund, you give cash to the manager of the fund, and in return, they give you shares of this money market mutual fund. But as you probably know, when you buy shares of a mutual fund, you have access to a prospectus that describes the strategy of that fund and what the manager may and may not invest in. And so if you're buying an S&P 500 index mutual fund, their strategy is going to be to track the S&P 500. They're not out there willy-nilly buying small cap or international stocks. They're only buying what's in the S&P 500. And if the manager deviated from that strategy and bought what they're not supposed to in the portfolio, they have a ton of legal liability. They're going to get sued immediately. So money market mutual funds, you hear the word mutual fund and you think, well, this is supposed to be liquid cash for a rainy day in an emergency. Why would I want to put it in a mutual fund? And the answer is because the money markets, what the managers are putting your proceeds, the portfolio dollars in, are short-term U.S. government bonds or short-term paper from highly rated corporations. And so years ago, prior to 2008, money market funds could invest in either of those options. And so to finance the U.S. government's operations, we're constantly issuing long-term bond, 10-year, 15, 20-year bonds and longer. But we also have a lot of revolving short-term debt, like anywhere from 7 days to 90 days in various maturities, in various forms. And money market funds are one of the largest purchasers of those debt securities. So federal U.S. government needs to borrow money to finance operations. They say, hey, we'll pay a couple of basis points or hundredths of a percent to borrow money from you for the next 2 weeks, and then we'll pay you back. That's what the money market fund is doing. They're buying that debt, lending the money, and then getting recouped directly by the federal government. Now, I mentioned highly rated corporations too. So before 2008, money market mutual fund managers could buy U.S. government debt obligations, short term only, no more. I think the limit is 90 days, if I recall, and debt from highly rated corporations. Corporations have the same financing needs. They go access the cash markets in the same way that the federal government does. And so then when the market started to tank and the mortgage crisis really set in, and you think back to when Lehman Brothers went bankrupt back in 2008, well, remember that the bond rating agencies had Lehman Brothers rated pretty highly until it quickly plummeted and then went bankrupt soon after. And the Reserve Primary Fund was at the time the biggest money market mutual fund that existed. And it held short-term debt in Lehman Brothers when Lehman Brothers went bankrupt. So when you buy a money market mutual fund, the net asset value used to be fixed at $1 for every dollar that you get, $1 per share, basically. So if you're buying $10,000 worth of the money market mutual fund, you get 10,000 shares in return. And they pay you interest through your shares in that fund. Well, remember that mutual funds have to calculate the net asset value of their mutual fund every single day. And when Lehman Brothers went bankrupt, the value of the Reserve Primary Fund fell below $1 per share. So now all of a sudden, if this is supposed to be a cash vehicle, you have $10,000 worth of shares. Now all of a sudden they're worth less than $10,000. This is supposed to be cash. People were freaking out. And that was a big deal. And the terminology there is the fund broke the buck. It was the first time that it had ever happened, to my knowledge, and it was a really big deal. And it freaked out all the investors in the fund. A lot of people rushed to sell their shares. They wanted to get out because they wanted their cash back. They thought they were investing in a cash vehicle. They weren't comfortable with that risk and wanted out. And the Reserve Primary Fund was forced to prevent people from getting out. So they had these liquidation. They were basically preventing liquidation, redemption prevention. So a lot of people were very upset by that, as you can imagine. The world is going bananas. Markets are crashing. Lehman Brothers, one of the Wall Street institutions, has just gone bankrupt. People wanted out, and they weren't able to do that. So finally, a few weeks later, the Reserve Primary Fund figured things out. They sold off portfolio assets in an orderly way and got everybody their money back, and again entertained redemption requests from investors. But after the dust started to settle from the mortgage crisis, the SEC and other regulators, I think the Department of Labor was probably involved too, they stepped in and reformed the way that money market mutual funds are organized and structured. And so rather than allowing money market mutual funds to invest in either U.S. government debts or corporate debts or both and give them the discretion to do that, they created two types of money market funds: government funds and prime funds. Air quotes for those of you not watching, just listening. The idea here was government funds are only allowed to invest in short-term U.S. government debt. Prime funds may also invest in short-term corporate debt of highly rated companies if they want to. And the rules surrounding redemption windows and the entertainment of redemption requests in times of duress were different between the two types of funds. So with a government fund, the net asset value is fixed at $1. Again, government funds may only invest in U.S. government debt, and they are forced to entertain redemption requests at any time. The mutual fund cannot prevent people from getting their money back if they want to. And because of the little bit of interest that you get in buying this short-term U.S. government debt on an ongoing basis, because it's 90 days or less, so it's constantly maturing and being rolled over into new debt securities, the liquidity is very, very, very high. It's basically as high as any security in the world. So prime funds, those that may also buy corporate debt, are a little bit different. The net asset value can float and deviate from $1 per share in prime funds. And in times of financial and systemic duress, prime funds may prevent investors from redeeming their shares for up to 45 days. And if I remember this correctly, I think the definition there is if they have enough redemption requests where they're forced to sell more than 30% of their portfolio holdings to meet the requests, then they may impose redemption windows and prevent investors from getting money back for up to 45 days. So that's a pretty stark difference. And you might think, well, why on earth would I want a prime fund if the net asset value can change, if the markets really go crazy and the world melts down like it did in 2008 and 2009 again? Why would I want that? And why would I want any kind of redemption prevention mechanism at all? And the answer is you get a little bit more interest out of it. So the chances of a permanent drop in net asset value in one of these things is exceptionally low. Anything can happen. It's possible. It's exceptionally low in the first place, and very worst case scenario, you're prevented from getting your money out of one of these funds for up to 45 days. So this is option number 2. We talked about option number 1. Where do I park my extra cash? What do I do with my emergency fund? High yield bank accounts, online bank accounts, are a really good option that I like. They're FDIC insured. Money market mutual funds are option number 2. And you have 2 choices. Prime funds are going to pay you a little bit more interest, not much, a little bit, in exchange for the risk that you're prevented from getting out of the fund for 45 days, which has happened before. Again, the mortgage crisis is the example there. If you're not comfortable with that, a government fund is the best way to draw it up. And we have clients who want to split it up 50-50. They've got a 6-month emergency fund. They say, hey, I'll put half of it in the prime fund, half in the government fund. Even if I'm not able to get my money out of the prime fund, I've still got twice the redemption window in cash in that government fund. So if you're prevented from redeeming for 45 days, 45 days times 2 is 90 days or 3 months. And if you have a 6-month emergency fund in the first place, then keeping half of it or 3 months worth in the government fund gives you plenty of latitude to get out of the prime fund later if you want to. Again, we're not talking about a whole lot of money here in the difference in yield that you get between the 2 vehicles, but it's really a nice option. And if you're someone who prefers to keep that idle cash, that extra cash, in a brokerage account as opposed to the bank, it can really work pretty well. Now, the potential reform on the table right now is relevant, because when we had the COVID sell-off in March of last year, so the last 3 weeks in March, as COVID kind of spread throughout the country and lockdowns really began, there was a rush on several of the prime money market funds. And I don't know off the top of my head whether they were forced to impose those redemption gates or not, but the regulators were concerned enough about it to where they're gathering comments and considering removing those gates entirely. So you would think that it would be great if a money market mutual fund got rid of those redemption gates entirely, because then, hey, I can invest in one, or I can put my cash in one of these prime funds and not have that risk at all and get a little bit of extra return out of it. And that could be true, but in order to accommodate that, a prime fund is going to have to come up with the liquidity from somewhere. And really, to you and me, to the investors, it usually means that they're just going to raise fees by just a little bit. So that extra interest could be offset by a changing structure of the fund itself. Now, this is not front page news, and maybe a little bit too far down the rabbit hole, a little bit too obscure for everybody to talk about in too much detail. But it's really interesting because what we do with our cash, how we keep it safe, is very important. And historically, money market mutual funds have been a really great option. I know a lot of people who use them and have used them for their emergency funds for decades almost. But with interest rates so low, they're a little bit less relevant today. I would guess that the rates that you can get in one of these money market funds, if rates around the market jump by 2 or 3%, might wind up being more competitive than what a bank can offer. Because a bank is a totally different entity than a money market fund. And at higher rates, access to the government window, basically, or the short-term financing of the federal government tends to be pretty appealing, whereas a bank is paying you a little bit of interest on your deposits and taking those deposits and lending them out to borrowers for a spread. So what I'm trying to get at here is the bank makes money because they borrow money from you at a lower rate than they're earning on the loans that they're shelling out that they're issuing with your dollars, basically. So as rates go up, they're really quick to raise the rates on the loans that they're issuing, but they're often very reluctant to raise the rates that you're paying you as a depositor. Because if they change both, their net interest margin, or the difference between their loans and their borrows, doesn't change. But if they're more aggressive on the loans than they are the borrows from you, your and my deposits, then their margin increases. And from the bank's perspective, they're just trying to gauge how sticky their deposits are. And if they don't have to change the rate that they're paying on their deposits when market interest rates go up, they're not going to. And so, compare that to a money market mutual fund. You have a professional manager whose job it is to get you the best rate as the investor. They have a fiduciary responsibility to do that job. A bank doesn't care. They're trying to make money for themselves and the shareholders. So apples and oranges, two different vehicles. But as you build a little bit of cash in the bank, as you get to the point where you have that emergency fund is established, really common question is, what do I do with it? Where should these funds live? Where should I park them? Either are a good option. I tend to lean toward money market funds, other things equal. All right, that's it for today. The subject can be a little bit dry, but cash is king and very important, so I hope it was a little bit informative. All right, that's it for this week. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.